There's a highway of stars across the heavens. There's a whispering song of the wind in the grass. There's a rolling thunder across the savannah. A whole pleasant dream at the edge of the sky. And your life is a story like the wind. Your life is a story like the wind. I'm searching for the spirit of the great heart. I'm searching for the spirit of the great heart. Under African skies. I'm searching for the spirit of the great heart. I see the fire in your eyes.
Good afternoon, everyone, and welcome to this webinar where we look at case studies from asset owners on investing for financial returns and socio-economic development. My name is Tanya van Lille. I'm the CEO of SAVCA, and we're so honored to be co-hosting this event with our partners Batseta and MiDA Advisors. If I can just ask you that if you have any questions that you'd like to ask, to please use the chat or the QA function at the bottom of your screen. And then later on, when we move to the panel, you are more than welcome to use the raise your hand function and ask your question in person or make your comment in person. The purpose of the event today is to showcase the possibility of investing into assets that can offer both financial returns and socioeconomic development. We are going to see presenters that will discuss their considerations and processes, and we hope that will assist you in your decision making as well. We will hear from the United States and from South Africa in terms of these case studies. I also just want to thank Batseta and MiDA Advisors by not only being here today, but also by hosting various of their own events. We recently saw the Batseta virtual conference being hosted successfully, and we want to congratulate them with a very good conference and good content. And also MiDA Advisors as they continue with their outreach onto the African continent and specifically on infrastructure projects. Before I start off and hand over to Anne-Marie and to Emmerich to welcome us, I'd like Bakiwe to start us off on our first poll, please. There you'll see a poll with 2 questions, and we can ask you to respond. The first is, which region do you represent? Are you from the United States, from South Africa, or somewhere else like Europe or Asia? Let's see where our audience is from. The second question is, if you're an asset owner, which type of fund do you represent? Is it a defined benefit pension fund, defined contribution, a foundation, or other? We see the results are coming in. We'll end the poll in a few seconds. From what it looks like on this side, it looks like the majority of the representation today is from South Africa. And the poll results are being shared. You'll see majority of our audience today is from South Africa. So welcome to everyone. Welcome to our colleagues from the United States and other regions. That's really good to see. And then the majority of the funds being represented here are other, but we also have defined contribution pension funds, defined benefit, as well as a small representation of foundations. Thank you, Bakiwe. Really appreciate that. I'd like to hand over now to Anne-Marie. Anne-Marie is from Batseta, Dalton, and I'd like to just ask Anne-Marie to just do an opening on behalf of Batseta and their constituency, and just talk a little bit about Batseta's role in the industry.
Thank you very much, Tanya. So let me say good morning to our colleagues in the USA. Good afternoon, South Africa. I never thought that I will say good morning and good afternoon without looking at my watch. But really, thank you very much for making time for us today. Now, I'm Anne-Marie de Alton. I'm the CEO of Batseta. and I'm greeting you from my house in Pretoria. Now, Pretoria is very well known for their jacaranda trees. I see there's the same in Florida, and it's October. And it's a beautiful, beautiful time of the year. Our streets are purple. And as you can see, I feel very sunny. I feel energetic. But I'm at a disadvantage. I can't see you. I can't shake your hand. I can't even do the elbow thing. So I thought that let's start this conversation by just let me see how you feel today, what your mood is like. And I'm just going to do a quick poll to assess that. So you will see, are you sunny today? Are you feeling a bit cloudy, rainy, thundery? Or is there a bit of a mixed feeling? So if you can just quickly complete that poll for me, because I think this will help us to see, what will be the demands on our speakers to keep you happy today. So let's see, will we close? Is it quick enough? Aha, 74% sunny. Thank you. So I think we're going to have a good session. And for the 13% and the 1% and the 10% there, we hope that at the end of the session, your mood has improved. So thank you very much for that. Excellent. So Tanya, now that we know how we feel, let me talk a little bit about Batseta. We're a professional body in the industry, the only professional body in the industry, and our members comprise of principal officers and trustees and retirement funds. And I can safely say that we represent about 85% of assets under management. So we have a membership of the top 100 funds, quite a lot of the smaller funds. So talking about investments and co-investments and, how are we going to assist in socio-economic development and infrastructure investments, there is an answer for everybody. There's an opportunity for everybody to participate. So one of the key roles as well, that we play as an organization, and the same with SAVCA and I assume with MiDA, is to create this platform where we can collaborate. And today is evident of, all those efforts that we put together to make sure that we offer you best-in-class education, training, skills development, and events so that when you go back to your boardroom, that you know what you need to discuss, that you have questions, and that you can really engage the kind of topics that you will find in your boardrooms today. Now, our president, Ramaphosa, has called for a session tomorrow, a parliamentary session. And what he's going to do is to discuss South Africa's reconstruction and recovery plan, economic reconstruction and recovery plan. And infrastructure investments is actually central to this, and retirement funds are expected to participate. So when we put this session together, we thought, let's talk about, the practice of pension fund investment decision making. And the reason why we're doing this, because there is a change in how pension funds look at investments lately. In the past, you will first look at the financials, the financial returns, and then think about impact. But that has changed now. First, retirement funds are more likely to say, what is the impact? What is it that we want to achieve? What change? What do we want to see? And then think about how to optimize those financial returns. And this is exactly what our panelists and our speakers will do today, is basically taking you through this, almost this life cycle of your investment decision making. You will hear from the fund itself, you will hear from the consultants, and you will hear from the investment or the asset managers, and eventually, what happens to that decision? What is the final outcome? And hopefully, at the end, there will be a bit of an indication of, the returns to be made in relation to this. So thank you very much, SAVCA. Thank you so much to MiDA, Americ Saar, the CEO that's here, Tanya van Lille, our CEO of SAVCA. Thank you very much for, putting this all together and working together to make this work for all of us. So what I would like you to do is to, just sit back, listen to our presentations, engage, ask your questions, have a little bit of fun. Because you know what, we can't see you. So if there's a little bit, glass of wine next to you, well, for the South Africans, I'm not sure whether that will be a good thing for our USA delegates. And thank you very much. Enjoy the afternoon with us, or the morning in your case. Thanks, Tanya.
Thank you, Anne-Marie, and thank you for bringing that energy to the session. We always love engaging with you. So thank you for that. I'm now handing over to Emerick Saha. He's the Chief Executive Officer of MiDA Advisors, no stranger to South Africa or to Batseta or SAVCA. So Emerick, over to you to say a few words of welcome.
Thank you so much, Tanya. And hello, Anna-Marie. It's a beautiful sunny morning here in Washington, D.C. So very pleased to join my friend in South Africa. Fortunately, I haven't been around too much this year, but I look forward to coming back soon. MiDA Advisors, we're very pleased to join you on this special event and to continue our partnership with Batseta and SAVCA. We are a implementing partner of the U.S. Agency for International Development. We are working to implement USAID initiatives and projects in Africa. And in this case, we are supporting investments in infrastructure. What we hope to achieve, Tanya, is co-investments between U.S. asset owners and South African asset owners. Anna-Marie talked about the South African projects and infrastructure. These are big initiatives, and what you need is a collaboration between local investors and international investors. So we're very pleased to partner with you to proceed on that agenda. I want to welcome our audience from the United States. I want to give a thanks to Joseph Boateng from the KSC Family Programs. He is a member of our advisory board, and he's going to be talking about case studies. But more importantly, we're very keen to continue our partnership and support the Batseta Asset Owners Forum in South Africa for seeking investments in infrastructure. As I said before, we have U.S. investors that are keen to further diversify outside of the United States, get exposure to emerging markets in Africa, and we think that infrastructure is the right asset class for them to pursue those opportunities. We are working with the USAID mission in South Africa, so I want to give a shout out to our colleagues who are from the mission joining us on this call. They've been a big supporter of our partnership, getting US and African pension funds to invest together, and I look forward to the case studies. I will be back at the questions and answer session, so I look forward to coming back to address some of the questions. In the meantime, I hope you enjoy the case studies. Thank you so much.
Thank you, Emerick, and thank you so much for the wonderful work you do to help the co-investment happen between the African continent and the United States. Bukiwe, can you please open the second polling question for us? We just want to see what the audience's investments into Africa look like. So the question is, what is your current allocation to investments in Africa? And remember, for those South Africans, it includes South Africa for the fund that you represent. So let's see what that looks like. The results are starting to come in. You'll see the results shortly as soon as we close the poll and share. But from this side, it's oscillating between unsure, more than 75%, and between 0 and 15%. Let's give it another few seconds, Bukiwe, and then we can start sharing the results. Okay, if we can share the results. So as can be expected, in terms of allocations to investments in Africa, it seems like it's between 0 and 15%, but it's also reassuring to see that there's a big number that is 50% and above. And those of you that are unsure, I hope when you go back, you ask the question in terms of what is your allocation to the African continent. Thank you, Bukiwe. I'm now going to introduce you to Joseph Boateng. He's the Chief Investment Officer at the KC Family Programs, where he's responsible for managing the foundation, $2.4 billion endowment. And he will unfortunately not be able to join us the panel. For those of you who are in South Africa, it's 7 o'clock in the morning there, and he's got an 8 o'clock meeting on that side. So he will present his case study. Unfortunately, not be able to join us for the panel. So if there's any particular questions you would like to ask Joseph, please ask them. I will address it immediately after his presentation, and the rest of the questions we'll deal with in the panel. Joseph, welcome to this event. Thank you so much for being here. I'm going to hand over to you, and then we'll start your slideshow as well. Thank you, Joseph.
Thank you, Tanya, and thank you, Amrik, Anne-Marie, and Kiwi. And thanks to everyone who is attending. I'll say good morning here, good evening in South Africa. Unfortunately, we cannot meet in person due to obvious reasons, but I'm not new to the region. As many of you can tell from my last name, I'm from Ghana, but I also CIO of Casey Family Programs, a US operating foundation. So we have people actually doing the work on the ground. And I'd like to talk about the foundation, and then I'll link it to the initiative and the efforts that we currently have underway here. I might start by saying that, sorry, I wouldn't be able to join the panel, but I'll take the easy questions after my remarks, save the harder questions for Amrik. So on the very page that you're looking at, Casey Family Programs is a foundation that was founded in 1966 to cater for the needs of children and families in America. The whole idea is to reduce the need and eventually eliminate the need for foster care. And that is who we are, and I'll come back to it. On the next slide, it talks about the founder of this foundation. There was a private businessman, Jim Casey, and Jim founded UPS, those brown trucks that you see blocking your driveway. Yes, he founded it. And in fact, 19 years before he set up Casey Family Program, he set up another foundation, Annie E. Casey, after his mother, and the family left the entire wealth, exception of the company UPS, which is still up and running, but they left the entire wealth to cater for the needs of children who are out of home care. So when we invest, we are basically investing for the sake of the children. We are investing for impact, both as an asset owner and also an impact for where those investments are made. So there's a symbiotic relationship there. On the next slide, we talk about profit with purpose. In fact, that's the only reason why we have a social license to operate. And as ex-president, former president of the United States, Barack Obama said, that our first task is caring for our children. At the end of the day, the morality of society will be judged by how we treat them. So this is front and center of everything that we do, and it will be at the front and center of the remarks that I'm making. On the next slide, our objectives, these are investment objectives. As an asset owner, one, I want to maintain purchasing power. That is, I want to return 5% plus US inflation and comply with all rules regarding private foundations, both here in the US and outside. So please pay attention to the 5% rule. And I think infrastructure investing, the opportunity that we see on the continent is ripe for that. We're looking for long-term income streams, and that is something that should allow us to meet that goal and comply with profit for purpose. On the next slide, I want to talk about how we are investing. So in 2007, when I joined this foundation, at the beginning, all the assets were indexed. At the end of the year, we still had 65% in passive, 24 active, mostly public. There's some real estate investments, mostly US-centric. Private equity was non-existent. Today, private equity is around 14, real estate inching to 5, just some roundings over here. Passive is almost de minimis, and we are active. And if we could go to the next slide. Now, active means long-term investing. We are long-term investors. We need patience for things to play out. Most often, the Anglo-Saxon approach, I commit to a fund, 5 years later, I want to exit, or I want to show some sales so that I can raise a bigger fund. That hasn't really played out very well, not only in Africa, but also in other regions that we invest. And my approach here is global, is a global team. So we invest in Africa, we invest in Asia, in LATAM. We actually like boots on the ground. So, but for COVID, we'll probably be doing this in person. I've traveled with some of you to various regions. But what you see here is the exposure by both from a sector and also from a geographic perspective. I want to point to the geographic perspective when you look on the right-hand side. So you have emerging markets ex-China, almost 9%. China is like 8%. Now Africa is in that green bucket. And I expect EM to increase because what we do is that we are quite agnostic to region, or to put it bluntly, geography. We go where we can find the best results. We go wherever the brown trucks and the airplanes of UPS go, we go there. Because if they can find value, we believe we can find value too. And to add to it, we also believe that doing good is actually good business, and that we can do good and also do well at the same time. Now, on the next slide, I want to talk about our exposure in Africa. And I'm going to spend some time here, and I'll link it to I'm sure some of the questions you have in mind. So I don't have a specific target for Africa, but so far I have over 10% earmarked, including actual investments we have on the ground. And it spans across both public and private. And I've had people on the ground, including myself and my team, travel through the region over the past 10 years. And that's the same approach we apply elsewhere, because when we are able to meet other asset owners, meet asset managers, meet businessmen, meet the operators on the ground, it gives us a different narrative, quite different from the headlines that we read. And it allows us to assess the risk that we have and be able to allocate accordingly. So from a regional perspective, I get that question all the time. Do you have any regional buckets? No, I don't. We are quite agnostic. And having said that, we have investments in North Africa, in West Africa, in East, in South Africa. We have investments in real estate, private equity, public, and also credit opportunities. In real estate, we've been at it well over 10 years. Most of it has centered initially on the Anglophone countries, both in West and East Africa and also South Africa. We moved into the Francophone as well, working through funds. In a number of them, we're actually seed investors. The result is mixed, I must say, but it's actually starting to look at. But there are some lessons learned, in that space. Private equity, we have some very good exits. What I have here is a global, exposure, but it's a huge Africa and LATAM sleeves. And we are invested in operating companies from logistics and so forth. In the public markets, I have dedicated African public equities managers, and certainly my global managers can do that. But I certainly didn't want a situation where most of the allocation, would go to Asia or just LATAM to the detriment of Africa. I have dedicated Africa and the Middle East doing well. And we are also quite active in the credit line. We're talking about loans and direct lending, one to businesses, to governments, and to, in some cases, startups as well. So let's look at the impact that we are making here. One, if you take the real estate, we're one of the first investors in shopping malls in West Africa. The assessment could be mixed, but I would say that definitely it offered jobs, income streams, destination for some. And in the case of the returns we got from it, it allows us to carry on the mission of providing for the well-being of children in foster care in the US. So what we've done is that we are having impact in 2 continents and also globally. We have that income stream, which is what we deem as building that human capital, which is the essence of the work we do. Private equity, as I said, we had a very good exit in a company which is now DTA public at the moment, and doing quite well. And actually, I've also made additional commitments in that space, and commitments on also energy, which also has a huge African slave. Because I believe that in order for the continent to realize its full potential, that energy deficit, which is part of the infrastructure deficit, needs to be addressed. On the public side, yeah, I've always had exposure there, but I see that we're able to have the most impact on the private and especially on the credit, where we've supported, energy, projects. We supported telecom companies, both in West Africa, in East and also Southern. We supported governments where they may have some shortfall in their, fiscal books, and in some cases, some bridge, financing, which has done extremely well. The net effect is, deepen the debt, capital markets. So we see the impact. And today, when we talk about Africa, it's not just about the headlines or Africa rising, but we can actually point to actual investments that have delivered. Part of the issue that we have is developing what I'll call the scale to put money to work. So that is one area that going forward, we are looking to partner, but for COVID and its unintended or consequences, we are looking at co-investment deals. There are a number of them, both in South Africa, in healthcare, in hospitality, in education, that we are looking at. The hospitality spans across both Francophone and Anglophone West Africa. Healthcare, across the continent. And some of them is the US, African partnerships with different players and with other asset owners who are like-minded. So I would say that we are open essentially, for business, because I see the opportunities on the continent for me is real. Not because I'm from Ghana or from the continent, because it is an investment which deserves merit and investments which deserves the consideration that we need. So we need to get our story out, and I would say thanks to SAVCA, Batseta, MiDA Advisors, and everyone here who is working in that regard. And as soon as we are ready to travel again, we'll certainly be on the ground. That is how we invested in Asia, and that is how we'll continue to invest in the other areas. I want to go to the next slide. And for me, this is very important when we talk about capacity building. It is not just making one investment and walking off because it did so well or it didn't. But we basically learn from whatever setbacks. I mentioned some in real estate. We use that as a launch pad to even, apply it in the investments, which, follow. So for me, it's an ongoing process. We need to get more money on the continent. It's ripe for investments, not just headlines. And we just need to be realistic with our return, assumptions, because if you look at the numbers, emerging markets and Africa has a lot to give, even in public markets. I'll pause here and take any questions that Tanya, you may have, and take it from there.
Thank you, Joseph. Thank you so much. There's a few questions that have come in. The first one is, what has been the impact of the exchange rate from emerging markets, especially on your Africa returns?
Yeah, thank you very much, and very good question. The impact of exchange rate has been muted, and I'll tell you what I mean by that. Basically, when we make our assessment or the case for investing, not just Africa, in any emerging markets, we include the impact of currency in the base case and how we can mitigate it. So it's one of the risk factors, just like poor execution, and something that we work into it. So it has been muted. And as a matter of fact, outside the United States, which has done extremely well, emerging markets has made the most money for me outside the US. Developed non-US hasn't done quite as well as emerging markets. One, we do not hedge because it's too expensive, and also because it might not even be effective. You may have to enter into some cross hedges, which is super expensive. So factoring it into the base case would be one, does the business that we are investing in have pricing power? Do they have receipts that are denominated in foreign currency, which provides a natural hedge? And better still, if the inputs are in local currency, but the receipts are in foreign, then I make money on both sides. And that has worked very well. Typically, you hear, things like, yep, okay, we charge our customers in dollars and in pounds or in euros, so we are okay. And say, really, what if they can't pay? What if you cannot pass it on? What if you have so much local currency, you cannot convert it into the hard cash and move it on? So it's a very holistic approach, and it's worked well for us, not only in Africa, but in Latin America and Asia. It requires more work, but that's the way we look at it, as a risk factor, which should be considered as part of the investment or the business case.
Thanks, Joseph. I think there's two questions, but we can actually marry them. The one was asking if you've got any energy projects that you've invested in on the African continent, and can you give us some examples? And the next question was, can you give some examples of investments made in Africa? I don't know if you can name one or two, but those were the two questions asked. I
can name many. So in terms of the investments in Africa, so we invested in the Accra Mall, Ikeja Mall, we invested in a mall in Cameroon and also in Mozambique. You talk about energy projects. We've supported, been very active in that space from the debt side. And there are a number of projects in Ghana that we supported. Actually, we had 3 loans, 2 directly to the players there and 2 of them to the government through them. So there's a whole list. You're talking about telecom, where we invested in MTN. We also did, Econet, Liquid Telecom. I have a list, but I just didn't want to go through, that list. And I'll say that if the intention or if behind the question is whether we are open to additional investments in that area, I'll say yes, we are. And there are a number of them that we are actually working on at the moment or at the end of last year, but as COVID will have it, we haven't been able to travel to the continent this year. And typically it's not just me, but I include board members and also members of my team, to do that. So we have certainly invested in these areas, both in energy, in hospitality, schooling, name it. I have a whole list that I can point to. Yeah.
Thank you, Joseph. And then there's one last question for you. Does the unrelated business taxable income, or UBTI, impact your investment decisions? And do you have any mitigants against this?
Thank you for asking that question. Something that I address every 3 years with my committee. No, it doesn't limit me. It doesn't. Fact is, if I'm not making money, I'm not paying taxes. Okay, and so it becomes an administrative burden. I would like to pay UBTI if I'm making money. I don't have any issues with it. But there are ways of mitigating its impact through a blocker corporation, or there are various ways of structuring it. So would UBTI or the prospect of having UBTI stop me from investing on the continent? No. I'm getting UBTI even from investments in the United States today. So UBTI does not, prevent me from making an investment. We talk about it. We certainly look at how we can mitigate it in terms of the administrative burden, and having a blocker corporation as an example, but it certainly doesn't stop us from investing on the continent.
But Joseph, thank you so much. Really appreciate it. You were wonderful. Thank you for sharing your insights. In summary, I think you just wanted to conclude with this slide, but thank you so much for joining us today. We appreciate it.
And so in summary, I'll say that whenever you mention the continent, especially given how EM has been battered in the last few years, you have a lot of naysayers, from the United States. I can talk to it because I deal with many other organizations, foundations, and pension funds. for me, it's an opportunity. The pricing is right. I think the continent is set for growth, and nothing beats partnering with other asset owners, working with other managers on the ground to unleash the potential that the continent has. So I'll leave you with this quote from Kofi Annan. Yes, every idea meets resistance, but we need to find that courage and take risks. And even if we fail, if the goal is worthwhile. Failure is not an option. I'll stand here saying that I've made money on the continent. We've had impact on the continent in many areas, and that's the way it should be. It should be about a symbiotic relationship, and doing good both in the US and Ghana is good business. And doing good in both the US and the African continent is good business. And that's the way we should do it. So thank you for the opportunity, and I certainly welcome any further conversations from the audience. Sorry I couldn't join the panel, but I'll certainly be in touch with Tanya, Americ, and Anne-Marie, and take it from there.
Joseph, thank you so much. We really appreciate it for being part of this. Bakiwe, if we can go to the next polling question before our next presenters are up. The next polling question relates more to alternative assets before we go there. And the question is, what is your current allocation to investments in Africa? We've done that one. Here we go. What is your current allocation to investments into infrastructure funds and projects for the fund that you represent? The results are coming in. Looks like for now the majority is between 0 and 5%. So it will be a good conversation especially for the next two case studies that we'll see. Thank you. We can close the poll and show the results. So as you can see, for the majority of the audience, allocation to infrastructure projects is 0 to 5%. Thank you, Bakiwe. Our next case study that we're going to discuss is, we bring it a little bit closer to home. And it is Soisile Mokweni, the chairman of the Consolidated Retirement Fund, and Raymond Wentworth, the principal officer at the Consolidated Retirement Fund, that's going to take us through their approach to investing in alternative aspects. And what's interesting is that it's a perspective from a defined contribution fund. So Soisile and Raymond, over to you.
Thank you very much, Tanya, for that introduction. Good afternoon, ladies and gentlemen in South Africa, and good morning to our audience in America. Let me thank MiDA, SAVCA, and Batseta for the opportunity to speak today on the use of alternatives within a defined contribution fund. My name is Soisile Mokweni, and I am the chairman of the board of trustees of the Consolidated Retirement Fund for Local Government, shortly known as CRF. I am also joined by the principal officer, Raymond Wentworth, and the two of us will handle the presentation between. I will now first hand over to Raymond to provide a brief background about CRF.
Thank you very much. Good afternoon, everybody. Good morning, people overseas. The CRF is a combined, defined contribution retirement fund, and we've got over 50,000, just under 30 billion rand of assets. The CRF is one of the largest growing local government funds in South Africa, and we provide members with excellent retirement solutions. Our intense focus on our members has resulted in the following achievements and innovations thus far. CRF has top quartile returns for members consistently in a risk control manner. CRF are leaders in responsible investing and impact investing within local government. CRF also seek to empower all its members and are one of the first funds to make affordable financial advice accessible to members. CRF is also one of the first funds to allow cost-effective post-retirement infant living annuities and the innovative infant pension option, which is similar to a hybrid annuity. We are leaders of the use of alternatives, having more than 14% in unlisted assets, 18% in alternatives, which includes hedge funds. This is very high compared to other defined contribution funds and in the country, and we break this down in the following slide.
As one could see, CRF has allocated more than 18% to alternative asset classes, but this is well diversified between various asset classes and strategies. Around 4% is invested in hedge funds, roughly 5.6% to private debt, 5.7% to private equity, and 3.1% to unlisted property. Now, contrary to the popular belief, Regulation 28 of the Pension Funds Act provides a lot of flexibility to invest in alternatives and unlisted assets. Many seem to believe that the limit is 15%, but the 15% limit only applies to private equity and hedge funds. The 15% limit does not apply to private debt and unlisted property. Of the 18.4% allocation, all of the assets, excluding hedge funds, have a high ESG impact. Therefore, 14.4% of our assets have a high ESG impact. 3.4% of our assets are invested in impact funds, all of which target job creation. This is important given our huge unemployment problem in the country. Around 2.8% is invested in renewable energy, and 3.5% is in infrastructure. The next question we always get asked is whether these alternative assets have added value. Most people believe that there is some kind of return sacrifice to investments that have a positive ESG impact. However, this is not the case, as we will show in the next slide, which will be presented by the Principal Officer, Raymond.
Thank you. We're going to look at the impact versus the performance now. Over years now, and not just over the crisis in March 2020, there has been no return sacrifice to the investment that has a possible social and environmental impact. We have compared each manager who manages the unlisted fund to a listed benchmark since inception of Manager A and top left chart runs an unlisted renewable energy debt fund, while Manager B, an unlisted credit fund, which has created more than 10,000 jobs since inception. We have compared the net returns, and it's important to know that after all fees and costs, we know that unlisted funds can be more expensive than traditional funds to the All Bond Index. Manager C, in the top right, runs an unlisted property fund, which has a high ESG impact in rural and township areas. We have compared the listed property benchmark. Manager D in the bottom left runs a private equity fund or Managed E runs an infrastructure equity fund, and we are compared both to the Swiss. Like any investment, alternative assets are at risk and be selective, and doing your due diligence is key. The managers that have selected have done well. You may wonder how we got such a high allocation to alternatives, and we will explain this in the next few slides. Looking at Regulation 28, our journey started more than 9 years ago when Regulation 28 was amended. We had very little allocations to alternatives. Firstly, Regulation 28 allowed generous limits to unlisted assets, and secondly, the preamble to Regulation 28 required funds to focus on risk management explicitly when referred to risk-adjusted returns. Further state the retirement funds should consider ESG risk in their decision making. Therefore, by not considering both the full spectrum of investment opportunities allowed by regulation as well as ESG risk, we felt that it would be breaching basic risk management protocols as well as Regulation 28. As a fund, we wanted to meet our members' financial goals, but also help them to retain prosperous communities and a clean, healthy, and stable environment.
Now, let us look at the journey of CRF in investing in alternatives. Our journey started back in 2011 when the Regulation 28 was amended. We set aside time to discuss ESG and risk management issues at our investment committee, but also considered investment opportunities in the non-traditional space. In 2013, CRF set a separate responsible investing policy and also decided to track the offshore MSCI ESG equivalent indices. The MSCI World ESG Leaders Index has around 23% lower carbon emissions than the parent index. It was intentional that the CRF started reducing its carbon exposure within its offshore assets before its local assets, recognizing that South Africa is still a developing country and heavily dependent on coal. So we adopted the just transition approach. In 2015, when the industry debated the concentration of Naspers in a local listed equity market, we noticed that our savings kept going into a relatively expensive and concentrated local stock market that was becoming increasingly global in its exposure. Companies were raising money locally to invest offshore, and often with poor outcomes. Our savings were not actually being invested locally and into real economy, while unemployment and inequality got worse in South Africa. To compensate, we actively tried to find opportunities that would provide commercial returns, but also invest into the local real economy. This led us to alternative asset classes. Most of the trustees also wanted to address the risk of large youth unemployment, and it was no surprise that our first unlisted investment was in a blended finance debt fund that target commercial returns, but also job creation. CRF also made commitments to renewable energy debt and renewable energy equity funds. In July 2016, we became a signatory to PRI to implement global best practice and to learn from others. After our first PRI submission, CFRF realized that engagement and being an active owner was just as important. What did we do? So in 2017, we engaged the Department of Energy when we submitted a response to the draft integrated resources plan, when nuclear energy was suddenly favored over renewables. Furthermore, in 2018, we engaged our asset managers extensively and shared learnings with them after the Steinhoff event. We requested our managers to consider board diversity and board refreshment when voting for company directors. We felt vindicated when the FSCA issued the Notice on Sustainability in 2019, as we felt that we were on the right path. In 2019, we completely revised our responsible investing policy to make it more specific and take into account the National Development Plan and the United Nations Sustainable Development Goals. Raymond will now cover the next slide, which indicate our target investment areas.
In CRA's revised responsible investment policy, we have set job creation and just transition as two key initiatives that we will support, and we expect our board asset managers to support as well. Up to at least 3 sustainable development goals. Asset managers will create products that support these initiatives, but also provide commercial returns will receive preferential allocation. The challenge that is set for the asset managers. CRF has already started to implement its responsible investment policy to funds that see commercial returns, but explicitly support both initiatives. To enable a just transition, as CRF increases exposure to the local green economy, it will seek to match this allocation with investments that explicitly create jobs. I'll ask the chair to conclude.
Sustainable long-term returns are important, and so is the duty to consider risk-adjusted returns as required by Regulation 28, which means considering the entire universe of investment opportunities. Viewing investments holistically is important for all retirement funds. And that means also understanding the impact of investments in the world members will retire into. It is no use simply targeting high financial returns in isolation. Even if you do meet your return targets, these returns will be meaningless if members end up retiring in wasteland, as the FSCA puts it. In other words, we must consider financial returns as well as the impact of our investments. Allocating to alternatives and looking at investment responsibly is a journey that all funds need to start with due care and diligence. The outcome can be very favorable for members, especially in a low return, volatile and uncertain environment, not only now, but over the long term as well. To help smaller retirement funds invest in alternatives, CRF are working on an innovative solution that might mitigate most of the issues that smaller retirement funds encounter when investing in alternatives such as liquidity, lockups, and high fees. So we urge you to watch the space. In conclusion, let me once again thank MiDA, Batseta, and SAVCA for the opportunity to present our case to this high esteemed audience. I would like to pause at this point.
Thank you so much, Raymond and Soyisile. It really seems like you are trailblazers, having thought about this for a very long time. There's a lot of questions that are pouring in, but we will deal with that during the panel conversation. And you also have your asset consultant joining you during the panel conversation. So that's fantastic. So thank you so much. We really appreciate you sharing your insights and being here. We're now going to move over to our next case study, which is looking at something a little bit more specific. So we went broader in terms of a pension fund. Now we're going to look at infrastructure specifically. And I'd like to introduce Vuyo Ntoye, Co-Managing Director of African Infrastructure Investment Managers, or AIM for short. And he has over 2 decades of investment experience, and he's going to talk to us about investing in South African renewables as a potential case study, or as a case study for achieving financial returns and socio-economic development. We are welcome, and over to you.
Thank you very much, Tanya. And again, it's a pleasure and an honor to be invited by Batseta, MiDA, and SAVCA to present a case study our ideas managed fund. Before I get into the meat of the socio-economic development impact of our funds, I think probably best to give a bit of an introduction on AIM and who we are. We are a private infrastructure investment house, probably the oldest dedicated manager of equity investments in infrastructure on the continent, having been established in 2000 as a joint venture between Old Mutual Group at the time and Macquarie, Macquarie being the Australian bank that had blazed a trail in private infrastructure investments. We have subsequently become a wholly owned subsidiary of the Old Mutual Investment Group, or Old Mutual Alternative Investments, but retain a lot of the DNA that the AIM business developed over the last 20 years of its existence. We're a 43-member investment team. We've raised 7 funds, made 61 investments and 29 exits, and we invest from 5 offices, being our Cape Town head office and our office in Johannesburg, but we also have a Francophone African office in Abidjan. We have a Lagos office that looks at English-speaking West Africa, and an East African office that's located in Nairobi. Thanks. Just as a snapshot, I said we're part of Old Mutual Alternative Investments. Old Mutual Alternative Investments covers the span of alternative investing, and that includes infrastructure. We have a private equity team as well as an impact investing division, which looks specifically at social infrastructure and educational investments, and a fund of funds business that looks to invest in private equity funds across the world. Next then takes us to the fund I wanted to speak about. So the Ideas Managed Fund, of which I'm also a co-portfolio manager, is an open-ended fund, private fund that invests in infrastructure projects. And our pedigree in that space was built up initially on investing in toll roads. So we are among the larger investors on toll roads in South Africa, the likes of Bakwena, N3TC, and TRAC. Those were some of our earlier investments. But over time, we've become really enmeshed in renewable investing in South Africa. And as part of that, we established a renewable energy sub-fund in 2013. And I think in keeping with the adage that you don't sacrifice performance by investing in socially beneficial projects such as renewables, which obviously have a profound impact on the environment, that fund since its establishment in 2013, has had in excess of 19% per annum in terms of performance, and that's a public number which is on our website. So thinking about impact, and I think the next slide sort of talks to our impact as a, or rather, sorry, it's the risk slide I wanted to speak to. Sorry, is that infrastructure is a secure way of investing in impact. I think there are a couple of ways in which the security of the investments is established, starting first with contracting. So the construction of the various projects that invest in infrastructure is typically risk mitigated through fully wrapped, what we call EPC contracts, construction contracts that are turnkey. So we take very little construction risk. The operations and maintenance contracts on what we build, so if it's a power station, if it's a road, are also quite watertight from a risk perspective, and the risk is typically passed on to the partner who's providing the ongoing operations and maintenance service. Revenue certainty is the other part. So typically you'll find in power stations there's a PPA, or a power purchase agreement, which essentially means that you're quite certain that you'll get your revenue over time. And typically these revenues are also inflation linked, which is positive. From a currency perspective, we heard Mr. Boateng speak about currency and what they do. In that regard, the truth is, in our Pan-African investments, we tend to look for projects that contract in hard currency. Obviously, we look for projects that contract in this manner sustainably. So there shouldn't be too much of a hit on the fiscus by guaranteeing currency outcomes on the projects we invest in. And typically, the projects we have also have government guarantees. So government essentially guarantees that there will not be expropriating the project, which is a very strong contractual risk mitigant for us. Further to that, in instances where you're signing contracts with the likes of an ESCOM, for instance, which isn't in a particularly strong financial position, the government guarantees also provide a backstop to the obligations of the likes of ESCOM. Where we excel, I think, as a team, sorry, is the fact that we do quite a bit of due diligence and research, and this is where the impact and sustainability of our projects comes in. We believe in doing lots of work on environmental, social, and governance, and we believe that this is what makes the project sustainable. First of all, you embed yourselves in the communities where you're invested, and the communities become a strong supporter of the project you're putting into the ground. You involve members of the communities from an employment perspective, in terms of shareholding in the underlying projects as well. And this really is then more than just a box ticking exercise around impact. It's an actual risk mitigant that we use as an investment tool to ensure that our projects are sustainable and reach the investment goals that they're seeking. Thanks. And in our investments, we seek to monitor the ESG impact of our portfolios. And this is just a sneak peek of the types of impact we see on our projects. We track ourselves in terms of the UN Sustainable Development Goals. You can see that, for instance, we've got 5,000 total direct employees across the entire AIM portfolio. 44% of those employees are females. 75% of female investment team appointments in our business, for instance, have been females, which drives gender diversity. We have quite a bit of CSI spend on the various projects we're involved with. We've added 1,370 kilometers of tarred road in terms of the toll roads we've invested in, and lots of other positive impacts that come from the portfolio. And again, I just highlight, it's not, this is actually risk management in our eyes, as opposed to something that takes away or detracts from performance. Thanks. And the project I've sought to highlight in this presentation is a project that's been implemented by one of our portfolios companies called REISA, which is Renewable Energy in South Africa, which owns a 75 megawatt solar park in the Northern Cape and generates 179,000 megawatt hours of clean renewable energy each year. So that's the positive environmental benefit. And it's enough green power to power 73,000 medium income South African homes. So from that perspective, it's quite large and scalable, and has quite an impact in terms of South Africa's environment. What we then look at, given the fact that we're located in a community, although it's a deeply rural community, is we've tried to then look at how we can positively impact the community around the project. I think the biggest risk to a project is if you build a power station, for instance, and the community right next door to that power station doesn't have power. It risks the sustainability of your project if the people you sit among don't enjoy the benefit of the service you're providing. So in that regard, we've had a number of initiatives, including a solar street lighting project in our host communities. One of them is the community of Dibing. And really, this is a community where crime was rampant in the evenings. There's lots of unemployment. But I think our street lighting project has really allowed the community to take back its streets in the evening. Children play out later. People are able to play sports such as soccer after school or work. And in areas where there is still a shortage of electricity, we've heard stories of where students use the street lights as their form of light inside their houses in order to study in the evenings. So beyond the immediate impact of safening the roads, people actually use the light for other purposes, even within their houses. And another initiative we've taken on within the project is the building of 11 ECD centers. We've trained 58 practitioners, and at the moment there are 783 learners who are benefiting from early childhood development initiatives. Again, as part of our enterprise development and social and economic development spend, we have an entrepreneur mentoring program in the communities around us, and this has achieved a 16% increase in overall jobs in the local community, which is quite a significant achievement, especially given the depressed nature of the rural communities in which we're based. And from a budgeting perspective, our SED spend has been 6 million rand thus far this year. Obviously, with the focus on COVID alleviation programs rather than the ones we have typically invested in. But over the course of the year, spend on social economic development within the communities around us comes to around 10 million rands, which is quite significant. Again, moving on to the next slide, what I wanted to highlight as well is that the South African renewable energy sector provides investors with kind of a strongly risk mitigated access to inflation adjusted returns, which are resilient through market cycles. If you look at our 1-year performance to the end of June, for instance, it's still pretty close to our CPI plus 7% per annum target, despite the impact of COVID on some of our valuation metrics. And again, since the inception number is pretty close to 20%. So what we're highlighting is that you don't need to sacrifice return if you invest in areas that do good for the economy and society at large. Thanks, Tanya.
Thank you, Vio. Really appreciate that. And thank you for sharing the actual example and the impact it has made. If I can ask my panelists to join me. Our panel today will be Emmerich. He will be joining us. Suisile, if you can come back. And then I'd like to introduce Shanel Suka, who is the Managing Director of Suka and Associates, a Black-owned and managed asset consulting company that provides services to pension funds and corporates. So thank you for joining us. There's a whole lot of questions that have come in, so we might not be able to address all of them today. Those questions that we do not get to, we'll ask our speakers to answer them, and we'll send them through to you directly. But the first question I want to ask is to Suisile, and it's sort of the elephant in the room. There's a lot of hype about prescribed assets, but what is the Consolidated Retirement Fund's view on the matter?
Let me talk about this. I think it's a very important and a relevant question to ask. Let me just say from the onset, CRF believes that Regulation 28 does not need to be amended, as it provides sufficient flexibility to invest in alternatives. As you would have seen from our presentation, that we have more than 18% in alternatives. We have invested willingly in alternatives, including infrastructure, and obtained good returns. Government, rightly so, wants to encourage investment in infrastructure to boost growth. So this is not unusual, and pension funds in the US, in Australia, are doing the same. However, we don't think pension funds should be forced to invest in infrastructure if it's not appropriate to their member profile, the needs, and liquidity. We do think that if asset consultants took Regulation 28 seriously and assist funds to demystify alternatives, more funds like CRF would be taking a proactive approach in investing in alternatives. Secondly, there has been a lot of fear and anxiety caused by prescribed assets. But when you look at the facts, the risk is very low. Just last week, ASISA, for instance, stated publicly that prescribed assets seem unlikely based on the feedback from NATLAC. Now, NATLAC, for the American audience, is our National Economic Development and Labor Council. Finally, we do feel that government should identify the project, incentivize pension funds to invest through guarantees, but then leave the management of the projects to the private sector. And I think if that approach is followed, I'm sure a lot of the concerns and anxiety would be eliminated.
Thank you so much. I really appreciate that answer, and it's a fresh perspective on the debate that's taking place in South Africa at the moment. Shanel, you are the asset consultant to CRF, and you've supported them through this process. One of the questions that came through is, give us examples of some of the high ESG impact investments. Which sectors and what are some of the liquidity constructs? Because especially for a DC fund, liquidity is important. So can you just talk us through that as examples?
Thank you, Tanya. Thanks for the opportunity. So some of the examples, while we classify, about around 14% of those assets as high impact, not all of them are impact funds. It's more around 3%, which are actually impact funds, which target job creation. Some of those funds are mainly to, private debt funds, lending to the SMME space, so small businesses. And we have actually seen how lending to that sector creates jobs. We classify also the renewable energy and infrastructure projects as having a high impact, not only from an environmental perspective, but if you look at the way the REAP program was designed, and I think Vuyo touched on this as well, there's money that gets set aside for communities in which the renewable energy projects are located. And as an asset consultant, we would engage with the managers to find out how is that money being spent in the community and whether it's being spent appropriately. So, those are some of the examples. From a liquidity perspective, we fully agree with the chairman who just mentioned now that a fund must look at their own member profile needs and liquidity. Alternatives may not be for everyone. And CRF is in a fortunate position that they are a growing fund. They do have sufficient liquidity, but we also think you don't have to go to 18%, let's say like CRF, but 5% for defined contribution fund is not a massive number. And I think being proactive on the liquidity management of that, we do think it's possible. It's not a difficult task.
Thank you, Shanel. I appreciate that. And we'll continue with the infrastructure example that's been brought up a few times. So Emeric, over to you. I want to talk about why Batseta and MiDA are partnering to create a consortium of asset owners for co-investments, particularly in infrastructure. And has there been any lessons learned from similar models elsewhere?
Thank you, Tanya. Yes, absolutely. We are working with Batseta to support their initiative to create a consortium for investing in infrastructure. We think it's very important because we understand that infrastructure is a complex asset class. It's not well understood. It requires a lot of capital, which you have to commit for a long term. And in some ways, you have to go through various stages before you get your funds back. But after construction, it provides you with stable cash flows. But before you get to all that, you have to invest in the due diligence. You have to ensure that you understand the asset class. You have to commit a lot of money. And we understand that a lot of smaller pension funds are not able to do that by themselves. So the idea of a consortium is a viable solution to support co-investing, whereby you can have leaders that have invested in the asset class, have already built the capacity to pursue infrastructure investments, have the capacity to proceed like that, but they can also bring about smaller pension funds that are not yet active in the asset class. And the consortium model allows for you to exchange, to collaborate, to share the cost, and to also share the risk and bring other asset owners that are not yet active in the asset class. And I think that as you're particularly considering the prescribed versus non-prescribed assets, I think that the consortium is a viable method to be proactive and still invest in the asset class because of the impact, but allow smaller and larger pension funds to work together. It's something that we have seen in other markets where we have seen consortiums also supporting such a vehicle because of the same reasons. We've seen that definitely in Canada with Canadian pension funds working with other asset owners. In Colombia, we've seen various pension funds here in the United States co-investing in infrastructure across different states. We've seen it in Kenya, where MiDA is also working with Kenyan pension funds to do the same thing. And we're very pleased to partner with Batseta to create the Asset Owners Consortium in South Africa. It's an initiative that Batseta is leading, and we'll be advising them under the USAID Invest project. So we're very keen to work on that, Tanya.
Emeric, that sounds fantastic, because I think it's always important to bring the pension funds that do not have the experience in this asset class or infrastructure along in terms of capacity, capability. So that's a great initiative. Good to hear. There's a question here for you, and it actually comes to what Emeric also covered about projects itself. But the question was, what is the capacity for new projects at the moment, and what is the quantum of assets that you can absorb into, let's say, an infrastructure debt fund?
Okay.
I think really.
Sorry, go ahead, Emeric.
That's to.
Okay. So I was about to say that maybe just for clarity, we are an infrastructure equity fund, but in terms of the capacity, I think what is almost always said in relation to infrastructure investments, both on the continent and in South Africa, the issue is not really the shortage of funds. It's typically the shortage of bankable projects to invest in. So where we stand is we've got capital that's been set aside for investment in future renewable investment rounds. And I think in truth, there shouldn't be a shortage of capital if there's a fair number of projects that are worthy of investment available. So in terms of capacity, I believe that even the debt markets in South Africa, which are usually covered by the banks, have quite a bit of capacity, despite the fact that we have an emergency procurement round at the moment, which will add a further 2,000 megawatts. I think the subsequent renewable programs should still have quite a bit of debt and equity capacity for investment. I think that's not to say that pension fund investors should relax. I think the truth is the more funds we have available in terms of dry powder, our ability to go to government and tell them, look, there's all this dry powder which is seeking investment opportunities. It strengthens our hand in ensuring that government procures more private sector participation in provision of infrastructure.
Thank you. Really appreciate that, Vuyo. And I put you on the spot there with the debt, but thank you for answering it so eloquently. So Isile, a last question from me to you is that in South Africa, one of the big hot topics is ESG. And it seems like trustees with their fiduciary responsibility is taking more notice of ESG factors or taking it into consideration when investing. Why has CRF embraced responsible investing?
Thank you, Tanya, for that question. My response is that the financial, political, and economic system is not sustainable in our view, especially if it continues to create outcomes such as high inequality, social injustice, structural racism in some parts of the world, environmental degradation, and irreversible climate damage. Maximizing returns in this situation seem futile if we won't have a planet to live on and our communities are not safe and prosperous. As a large fund, we are also looking to see if we can assist smaller pension funds to invest in alternatives. We are in such a difficult and unprecedented times that we need to think out of the box and help each other. And that is the reason why CRF embraced responsible investment.
Thank you so much. Really appreciate that. And then there's a final question that maybe Vuyo and Shanel could quickly answer. There was a question about real estate and the impact that COVID will likely have, or the negative impact that COVID will have now and in the foreseeable future, given that people are moving to online shopping, and we're seeing that working from home has also risen. So should real estate be prioritized as a sector? So any thoughts on that?
Yeah, Tanya, if I may go first. Yeah, I do think, real estate does have some headwinds, as we've seen with digitization, people doing more online shopping and work from home. It will affect retail, commercial and office property, real estate. But yeah, I mean, as you can see, I mean, one of the charts that CRF showed was of a real estate fund, an unlisted real estate fund, and most of the investments are more in the township and rural areas, where access to online shopping is not available, and that's one of the reasons why we diversified the exposure away from the metros and urban areas, and this was back in 2015. We were also concerned at that time that property valuations in metros, just the overdevelopment, we were concerned about those risks. And again, it was a risk management decision to diversify into other areas where we saw more resilience. But yeah, I do agree, it's a difficult one. There's still headwinds. But as a contrarian investor, we do get excited about just the valuations that are starting to emerge from the listed real estate sector. But yeah, I think it's going to be a tough one to call.
Yeah, not being a real estate investor myself, I'd say that what Shanel is saying about valuations and the opportunity set probably rings true, in the sense that people would probably more likely panic, and prices are probably depressed to an extent to which the new normal is quite discounted already. So there's potentially an opportunity there. Also, I mean, with the rise in online shopping, I think warehousing, for instance, will be a property sector that potentially benefits as people stop visiting storefronts and the like. And with my infrastructure hat on, I think obviously the telecoms opportunity in terms of fiber, etc., will also be increased. But then again, it's with caution, because I don't think we can look at this year's events and then kind of extrapolate them into the future. So we probably have to wait and see what the ultimate outcome of these trends is as well.
So then the last question for you that just came in is that the government developed the NDP, but not much has been implemented. In terms of economic recovery, weighted heavily on infrastructure, do you feel, in terms of your opinion, the government's committed to infrastructure development and getting it off the ground?
Yes, I do. I mean, I think the amount of engagement we've had with government in recent months through organizations such as CISA have been quite significant. It's the most we've interacted with government as private investors in infrastructure. Certainly more engagement than we've had over the past 20 years. I think we're reaching a point where government is now understanding the type of projects and types of support that the private sector requires for the implementation of this infrastructure. And I think the low-hanging fruits, which are kind of projects that have been in development for quite a while, are being brought forward. So I think the emergency procurement round 5 renewables, etc., are being brought to the fore. There are other sectors where government is looking to access private sector funding, and I think those are the ones where we're still discussing the mechanisms through which those projects can be brought to market. But certainly, having the infrastructure fund established and having hired a team to take that fund forward, we do believe that there's going to be a lot of co-investment opportunities with government going forward.
Brilliant. Thank you so much. There's still questions streaming in, but unfortunately, we've run out of time. We'll get those questions through to our panelists and hopefully send them through to you directly for those that have asked. Thank you so much, panelists. I really appreciated that you presented and that you've shared so much of yourself and of your insights with us today. If I can please ask Emeric to stay with us as we come to the closing, and for Anne-Marie to join us. And Emeric, in your closing, maybe you can also just briefly talk through some of the examples that you have of US asset owners with MiDA's recent investments in infrastructure on the African continent. So Emeric, over to you, and then we'll ask Anne-Marie to close us for the day.
Thank you, Tanya. Again, we are very pleased to partner with Batseta and SAVCA for this special event. MiDA was really created at the end of 2016 by the US government to help bring about more co-investments in infrastructure in Africa. And over the last 4 years, we have been able to mobilize over $1 billion from various US asset owners investing in Africa and other emerging markets in infrastructure and private equity. To give you some examples, we've seen the San Francisco retirement system invest in $100 million for power projects throughout the continent. We've seen Texas teachers recently invest in an infrastructure fund that is very active across the African continent. We've seen Sarah from California invest in various funds that will be investing in real assets across the continent. We just heard from Joseph Boateng from Casey Family, another MiDA member. He's been investing in Africa for a long time. And the list goes on. With Prudential, we have Cappers, and we have other asset owners. Chicago Teachers investing recently in 2 funds that are based in West Africa and investing as well in South Africa. So there's a whole list of asset owners that are interested in further diversifying into the continent. And what is very important for us is to partner with African asset owners. Eskom Pension Fund has just recently co-invested with Chicago Teachers in a private equity fund that is investing throughout the region. And we're seeking more co-investments. I think Joseph Boateng also talked about that. So this is our mission. This is what we intend to do going forward. We very much believe in the partnership with SAVCA and Batseta. It gives us boots on the ground, as Joseph said. It gives us a local perspective, local knowledge, and networks. So we're very eager to proceed with our partnerships. And I want to thank everybody for joining us today from South Africa, from the United States. And until next time, you'll be hearing from us. So thank you so much.
Thank you, Emeric. Really appreciate it. That's music to our ears in terms of this co-partnership, and the real examples show that there's been so much progress. So thank you.
Thank you.
Anne-Marie, over to you. You've got the closing remarks. The floor is yours. And let's end off with the energy you started.
Yes, no, absolutely. You know, boots on the ground, Tanya, boots on the ground. And this is actually what this conversation was all about, making sure that we activate and that we start doing. You know, I think there's enough tangible proof and case studies and examples to see that, you know, this can be done, and that, you know, funds are already very successful when they invest for impact. Just a quick mention of the Asset Owners Forum South Africa that we are busy with. We've already established it. It will be launched soon. And, you know, we brought retirement funds together, the top 20 as a start, to discuss how are we going to take this whole investment into infrastructure and socio-economic development and into the economy forward. There will be one access point, which I think will also help with the collaboration. And we will launch it soon, so watch this space. We will let you know. But thank you very much for everybody that participated today. Emeric, it was good to see you again, and all our colleagues in the USA. You still have a whole day ahead of you. We are going to have our glass of wine now, and we are looking forward to our next session. And thank you very much, Tanya, for a fantastic facilitation. And for everybody that asked questions and participated, yeah, you're all awesome. Thank you so much.
Thank you so
have
much.
Have a good day. Stay safe. Keep your masks on, eh?
Thanks, everyone.
Thanks.
Have a great afternoon. Thanks, Emerick. Thanks, Anne-Marie. We love our partnerships with Batseta and MiDA Advisors, both represented at the SAVCA conference every year. So thank you for that, and looking forward to seeing you at the SAVCA conference next year, 3 and 4 March. Have a great evening, everyone.
Goodbye.